Good morning, ladies and gentlemen, and welcome to the SEQUOIA Economic Infrastructure Income Fund investor presentation. Throughout this recorded presentation, investors will be in listen-only mode. Questions are encouraged. They can be submitted at any time via the Q&A tab that's just situated on the right-hand corner of your screen. Please just simply type in your questions and press send. The company may not be in a position to answer every question it receives during the meeting itself. However, the company can review all questions submitted today and will publish those responses where it's appropriate to do so on the Investor Meet Company platform. Before we begin, we would just like to submit the following poll, and if you could give that your kind attention, I'm sure the company would be most grateful. And I would now like to hand you over to the team from SEQI. Randy, good morning, sir.
Good morning, everyone. Welcome to our fiscal year 25 results call for SEQI. This covers the period 1 April 24 through 31 March 25. I'm Randall Sandstrom, and with me this morning is Steve Cook, a partner and head of portfolio management at Simco, and Matt Diamond, managing director and head of client capital. If we turn right to the introduction on page 1, SEQI is a platform with scale, and it's been proven through the cycles. We have a 10-plus year track record of meeting dividend targets in volatile market conditions. SEQI is a market-leading listed credit fund with scale and a NAV of £1.4 billion. The shares are liquid with an average of 3 million shares traded per day, and we have a low cost structure. We've had a resilient performance this year, and there's upside potential. The total return for the year was 6.1% on a NAV basis, and there's upside through a portfolio pull to par of an expected 4p per share as the loans approach maturity. We've had a leading share buyback program and have acquired over 213 million shares since July 2022. The portfolio has a high yield of 9.9%. The dividend is cash covered at 1 times, and at the current share price, the dividend yield is an attractive 8.8%, which is more than double the 4% in 5-year gilts right now.
Thanks, Randy. Turning on to page 2, I want to touch on some of the financial highlights of the year. I think the first thing to say is that we saw a lot of continuity with previous years. So the portfolio yield to maturity, which is a key measure of future earnings capacity on the investment portfolio, remained practically unchanged at 9.9% versus 10% for prior years. The fund has also remained a very similar size. So total gross assets have been constant at £1.5 billion. Total net assets are slightly lower, mainly as a result of the share buyback at £1.4 billion versus 1.5 previously. The net asset value per share of the fund has slightly declined, and we'll go through a NAV attribution bridge on the next slide. But that resulted, once you take account of dividends, of a NAV total return of 6.1% over the year, which is slightly beneath our target return of 7 to 8%. Over the year, we also saw the fund's discount to NAV widen fractionally from 13.5 to 15.4%. That has since year end partially reversed, although it's still obviously at a discount, and we'll talk again about that later on in the presentation. And then finally on this page, the portfolio's ESG score has improved, and we'll talk more about ESG and sustainability, but this remains a very important initiative for us. Turning on to page 3, here we have a NAV attribution for the portfolio. As you can see, the opening NAV was 93.77 pence per share. Interest income added 8.17 pence. And then against that, there were negative adjustments of 1.45p, including the effect of FX hedging. Most of that is attributable to one carrying adjustment on a non-performing loan. And again, we'll touch on that later. Other adjustments are relatively small. Acquisition costs of 0.17 are just the cost of marking things to the bid side of the market. That's a non-cash cost, obviously. Expenses and share buybacks are self-explanatory. Turning on to page 4, here we have an analysis of the pull to par impact on the portfolio. Just to remind people what this means, this is the unwinding of discounts on performing loans as they get closer to maturity. In other words, what happens is if interest rates increase, since we made a loan, for example, or discount rates increase, the carrying value, the mark on the loan will typically be at a discount to par. That's obviously unrealized price adjustment. And as the loan gets closer to repayment date, the price will go back up to par, right? So that's called pull to par. It's a mathematical or consequence of the way the loans are valued. And what you can see is that over the next 4 years, that adds up to about 4p per share. But interestingly, that's quite front loaded. So about 3/4 of that will come in, we think, over the next 2 financial years, and actually more than half over the coming financial year. I'd make the point that actually, although interest rates might rise faster or fall faster than expected, they may behave in some unpredictable way, of course. In fact, that won't affect the total amount of the pull to par, just the timing that we see on the income.
Thank you, Steve. If we turn to page 5 and look at the portfolio as of fiscal year end, things have not really changed that much since fiscal 24 year end. And if we just start right at the top, you can see that we, of course, still maintain high diversity with 59 positions in 8 different sectors and 29 subsectors, which are shown across the bottom of the page. You can see the average life remains a pretty short 3.4 years. The construction bucket has ticked up a little bit. That's not part of any theme. We just saw a couple of good opportunities recently, and we picked them up, but it still remains well below the 20% maximum. Over on the right-hand side, you can see that our senior secured exposure is at 60%. And that, of course, is the lowest point of risk in the capital structure. In terms of fixed and floating, we were at 59% as of fiscal year end on the fixed rate side, and we increased that a little while ago to take advantage of a lower rate environment.
Thanks. Turning on to page 6, I want to say a few words about the credit performance of the portfolio. As you know, we target high yield or sub-investment grade debt, so it's inevitable that we're going to have credit consequences or credit problems from time to time. However, that is mitigated by having a highly diverse portfolio and also by the fact that infrastructure typically has lower default rates than the wider market and also better recoveries following a default. So when we look at our portfolio, we've got good reasons to expect outperformance versus high yield bond and leverage loans. In fact, that's what we have seen over time. In terms of our current NPLs, we have 2 positions which between them contribute less than 1% of net asset value. One is a school in Washington, D.C. This has been a long-running transaction in the portfolio, which was failed as a result of COVID. Unfortunately, the defunding of the Department for Education early this year as part of Trump's initiative, sort of efficiency drives, has resulted in further delays in releasing up this, and we took the decision to reflect that in a write down of the carrying value. That contributed to the decline in the NAV over the year. The second one is a small loan which we're not able to disclose its name currently due to legal reasons, but I would say I think it's marked very realistically and it's backed by real assets, and that's what's driving the valuation of that loan. Other NPLs have performed well, have been exited. So Bulb, we now expect a full recovery on. We're no longer including that in our NPL reporting. The loan on Clyde Street has been exited. We've got some further earn-out potential, but the actual loan has been sold. And we also finally fully exited the Salt Lake transaction in Australia, where we had a very small residual piece, which we sold during the year.
Thanks, Steve. We'll now turn to the SEQI total return performance. On this slide, you can see 3 lines. One is the SEQI NAV total return. That's the black line. The second is the SEQI share price total return, the dark blue line, and the light blue line is the high yield bond benchmark. Some key features of this. Well, firstly, our NAV total return, which we see as the sort of core performance measure for the fund, has consistently beaten the high yield global benchmark by between 3 and 4% per annum. It's closer to 4 at the moment. That's obviously a key measure for us in terms of benchmarking what we see as a already very attractive asset class, but actually beating the global standard for this huge sort of high yield market is very important for us. Secondly, when you compare that to the return over risk-free rates, in the top right, you can see our cumulative NAV return spread over risk-free rates is over 5%. So what else does that mean? Obviously, we've got the challenge of the discounts, and I'll come to that more in a second. But a key statistic that we would like to talk about is our cash generation. The business is highly cash generative since the IPO. We're pleased to have reached the landmark of about £750 million of dividends paid since IPO, which really does represent an extraordinary measure of cash flow performance. So on discount control, I mean, this is a major point for us, as it is for other players in the London listed alternatives industry. So there are several things we're doing to continue to maintain pressure on that discount and narrow it. Firstly is the buyback. We were one of the first in the sector in terms of investment companies to launch a buyback, and definitely within our peer group, the first to lead a program such as this. Since July 2022, we've repurchased about £213 million of stock. That's nearly 13% of the original or the previous issued capital. However, we are very keen to continue to balance this with new transactions. Now, why do we do this? And we do this to maintain strong diversification in the fund. This is really important for a credit fund, and also maintain what we call thematic freshness of the portfolio. Even in the infrastructure world, which is relatively protected and defensive, it's very important to stay thematic and fresh. With an average life of less than 4 years, we are able to roll over the portfolio into these strong themes. Finally, I would say we can, in current markets, lend at attractive rates that are not too far off what you would call the buyback yield. In other words, the return to shareholders from buying back ordinary shares. Beyond the buyback, there are several things we do to enhance the marketability of the shares, which is another feature of discount control. Firstly is transparency. We maintain monthly reporting with an external consultant in the form of PwC, providing a high confidence in our monthly NAVs. Secondly, we have what we believe is a very competitive fee. Over the last year, our ongoing charges ratio has been within the lowest quartile within our peer group. We continue to take 10% of the fee as the manager in SEQI shares, which aligns the interests with our shareholders. We would also note that being a fund with a revolving portfolio of loans with, in general, less than 4 years life, it is a pretty intense management process. We have to continue to reinvest, keep the portfolio fresh, as well as keeping our origination processes highly active and the monthly reporting and so on. Finally, we're working very closely with other advisors to SEQI, both in the UK and overseas. So that's with Jefferies and JP Morgan, with Kepler, and our PR advisors, Teneo, to enhance the understanding and appeal of SEQI's very strong proposition.
Thanks, Matt. Turning to page 9, I want to say a few words about the company's ESG and sustainability policies. This remains a very important focus for us and the fund, and in a number of ways. One is clearly the high level of reporting and transparency that we pride ourselves on. This year's sustainability report is, I think, exceptionally detailed, and as usual, we've mandated KPMG to come in and do limited assurance on the reporting that we give to our investors in relation to sustainability metrics. So that's one element. Secondly, obviously, asset allocation. needs to reflect our ESG priorities. So there remains a number of sectors where we have negative screening, where we simply don't invest. There will be things like coal-fired power stations, upstream oil and gas. We don't do military infrastructure, etc. But at the same time, we also look to prioritize. We have positive screening for infrastructure with social benefits, or which are focused on renewable energy or help energy transition, etc. And then thirdly, we're very focused on engagement with the companies that we invest in, the companies we lend to, making sure that they have got strong ESG policies, that their level of reporting is accurate and comprehensive, that they have appropriate covenants in loan agreements to ensure a high level of environmental compliance. And that's not just done for the purposes of ESG policy. We also have seen a very strong correlation over the years, I would say, between things like companies with good governance, companies with good environmental policies, and credit quality and performance. So I think there's a natural alignment between how we think about sustainability and how we think about portfolio performance. Turning on to page 10, got here 3 very short case studies of investments over the year. And they're all very different. The first one is Community Fibre, which is a fibre to the home, a broadband business in the UK. It's been a very strong business. I think what makes this interesting is the sector as a whole has clearly had some challenges over the last couple of years, and that's in relation to build out, perhaps overbuild in some areas, perhaps competitive pressures, lower take up than expected. There's been some headwinds across the sector, and that's led to a repricing of capital. I think that's created an opportunity for us to lend to very strong businesses like Community Fibre, top tier businesses, and still get attractive economics on the transactions that we do. The second is a German transaction. It was just shy of a 30 million euro loan as part of a 112 million transaction. So we were about a third of the overall financing. It's a club deal where we refinanced existing debt and provided funding for growth. And this company provides diagnostic imaging and radiotherapy services. It's a very highly regulated and constrained market in Germany with high barriers to entry. And therefore, we think it's a business with very attractive prospects. And then the third one is a infrastructure services business in the UK. We provided £40 million of senior secured financing. And this is a company which is really helping the UK transition to both low carbon, but also digitally connected economy. And they provide a range of infrastructure services across a number of different sectors, including fibre, energy, and water networks.
Thanks, Steve. Turning to some market prospect-related issues. Firstly, on the next page, we've got an overview of some of the megatrends and the impact on the growth of the market in which we operate. There are a lot of words for these megatrends, and there are some overlaps between them, but there's no doubt that each of them has undoubted power and impact on our business as well as life in general across economies. The first is decarbonisation. This is also known as energy transition, and we've seen that in not just in renewables, but we've seen that in backup power. We've seen it in the LNG market in particular, which is a critical supporter of renewables in the way that it provides the fill-in for the variability in the output of typical renewable generation sources. On digitalization, a day doesn't go by without us seeing headlines on this, whether it's related to Bitcoin or to the impact of AI. That's all around us, and that feeds back into the requirements for infrastructure. And that's data centers, it's towers, it's wires, and all of the connective tissue of the digital world. Demographics, this has probably been the one around for many decades, particularly in developed economies with aging populations, with the need to renew and refresh older infrastructure. It includes urbanization and obviously advances in healthcare, and other trends that are demographically related. And finally, what people are beginning to call deglobalization. This may be something that is perhaps a shorter trend, but it is nevertheless significant, and it somehow backs up some of the other ones in terms of requiring a more sort of defensive infrastructure setup, whether that's energy security or other backups for digital and elsewhere, which means that more money is being spent on duplicating or reinforcing infrastructure in many different ways. Now, what impact does that have on the growth of our market? We're investing in private credit, and a good example for the growth of that can be seen in the global infrastructure private funds market, which essentially was created in the mid 2000s and has grown spectacularly since then. It's now comfortably over $1 trillion in terms of infrastructure equity GP funds under management. Now, what's interesting is actually debt is really playing catch up here. It's less than 1/7 of the size of the equity equivalent, and really is in high demand. So there are relatively few cross-border or global infrastructure debt providers compared to the number of infrastructure equity providers in the market. And this is a huge opportunity for the SEQI fund. Turning specifically to the US, listeners will be aware that about half of our portfolio has typically been in the US market. Clearly, it's a market that's seen a lot of headlines over the last year or so. So we felt we should just give it a little bit of a focus here. Now, while the broader political and economic outlook for the US remains challenging for broader investment, given some of the additional uncertainties provided by tariffs and other potential new policies that are underway in the US. We believe that infrastructure is relatively protected and defensive in this regard. Infrastructure is fundamentally domestic in terms of operations and the client market. And in terms of the supply as well, US banks have been notoriously underinvested in infrastructure. So there's strong demand for it from the domestic requirements. And this is a bipartisan priority, perhaps putting renewables aside. But in terms of transportation, in terms of broader energy, healthcare, and so on, it really is not just a national, but regional and local priority to improve and expand infrastructure in the US. This is proven also by some reports, for example, by the American Society of Civil Engineers that does a report card every 4 years. The latest one came out in March this year. They give themselves a C grade, and the reason that they give themselves that relatively low score is partly down to the challenges in terms of financing. So they've identified a financing gap between what is planned over the current decade to be put into infrastructure versus what infrastructure requires in the US. And they've identified that as a minimum of $3.7 trillion, with various other factors perhaps contributing to a much larger number. So that really does feed into an enormous continued opportunity for the likes of SEQI over the years ahead. I would say also on the credit side, and this is not just for infrastructure credit, but for broader credit as well, the US market typically represents half or more of global high yield credit transactions.
Thank you, Matt. If we turn to page 13, we thought that this yield graph was quite interesting. And what it shows is where US dollar and euro corporate bond yields have been over the life of SEQI. And it really highlights the many cycles and in some cases quite profound cycles that we've been through and the ups and downs in bond market yields. And I think that this volatility is in contrast to SEQI's steady performance and consistent returns over the life of the fund. If we now turn to page 14, we'll give some closing remarks. SEQI has had and is expected to have attractive long-term performance. It's had 10 years of paying steady dividends, and its NAV total return has been well ahead of high-yield corporate bonds. The fund is agile because it's very cash generative, which we've talked about, and this is due to the short average loan life in the portfolio and also the portfolio high yield. And this high portfolio cash generation has allowed us to fund the buyback and make new investments while tracking the thematic evolution of global infrastructure, such as the increasing importance of energy transition and digitalization. The fund is transparent with fresh monthly NAVs and valuations by PwC, and it's been resilient in what's been a pretty volatile world. Its infrastructure, which is typically essential, and this makes it less correlated to the business cycle. Its credit with structural protections built in through covenants in our loan agreements, which protects our shareholders. And this is compared to and in contrast to equity, which represents first loss risk and at the bottom of the capital structure. Its income, and we have a long-term track record of earning a premium yield over high yield corporate bonds. And then finally, it's highly diversified by sector, subsector, counterparty, and jurisdiction. And this high diversity reduces the portfolio risk in SEQI. This ends the presentation part of today's results call, and we'd now like to turn it over to Q&A.
Perfect, guys. That's great. And thank you very much indeed for your presentation this morning. If I may just jump back in there before we move to Q&A. Ladies and gentlemen, please do continue to submit your questions just by using the Q&A tab that's situated on the right-hand corner of your screen. But just while the team take a few moments to review those questions that have been submitted already, I'd just like to remind you that a recording of this presentation, along with a copy of the slides and the published Q&A, can all be accessed via your investor dashboard. Guys, as you can see there, we have received a number of questions throughout your presentation this morning, and thank you to all of those on the call for taking the time to submit their questions. But if I may just hand back to you just to read out those questions and give your responses where it's appropriate to do so. And if I pick up from you at the end, that'd be great. Thank you.
Yes, sure. Absolutely. Thank you very much for that. Okay, so first question is about the dividend. And the question is, what's sort of a comment and a question? Given that the dividend coverage would have been over 1.1 without the buyback, and that 13% of the shares outstanding have been bought back already, and the dividend cover is likely to be higher next year, do we have any plans on increasing the dividend? And the answer to that is there are no plans to increase the dividend. Yes, we do expect the dividend cover to increase, but that's mostly due to the timing of PIK or deferred interest that's received. And although that's absolutely great news, it's not really a basis for increasing or changing the dividend. We're happy with the dividend where it is. The current dividend yield, given the share price right now, is 8.8%. And as I said during the presentation, that's more than double the 4% right now that folks can earn by buying 5-year gilts. The next question is, do you intend to cancel the shares bought back like we did a while ago? No immediate plans to cancel the shares that are in Treasury. That's the term, they're in Treasury. The listener is absolutely correct. We have canceled shares in the past once they reached a certain level, but we're not at that level yet, and there are no plans to cancel the shares in Treasury.
Thanks, Randy. Next question is where we're currently seeing value in the portfolio. Where do we see opportunities? I think it's quite broad based. We do have a strategy of looking for a diversified portfolio. I think that's good risk management. But having said that, clearly some parts of the market are better value than others, and that's where we focus. So right now, we think the power sector is very interesting. There's obviously increasing demands for energy being driven by, for example, data centers, by older plants continuing to be decommissioned. That creates opportunities. as does a lot of the ancillary activities associated with that. So so-called grid stabilization, energy storage, rapid response to fluctuations. So things like trying to avoid some of the power cuts that people remember in Spain earlier this year. You know, they require investment. It's not specifically a Spanish problem. As you get more renewables on the grid, you have to invest in a whole host of ancillary activities to ensure grid stability. So that's a very interesting set of opportunities. We're still seeing good opportunities in digitalization in general, and that's likely to be the case. And geographically, we think that right now there's very good opportunities in the UK and Europe, and we're a little bit less enthusiastic about the US than we have been historically. It still remains our largest single market. It's about 45% of the portfolio, but that is a decrease compared to 50 to 55% a couple of years ago. And that's clearly because some parts of US infrastructure are a little challenging right now, given some of the political changes that are going on. Next question is relating to cash drag. And the question is, I think, what caused it? Is it caused by the time it takes to do good due diligence on projects? And do we expect cash drag to continue? So just to sort of clarify this for the benefit of all listeners, cash drag is simply the cost, the opportunity cost of sitting on cash, right? We put cash into a deposit account, it earns, call it 3.5% or 4% or something like that. But clearly, if we make an investment, that yields 8 to 10% typically. So we have an implicit cost in sitting on cash. The answer is it hasn't really been caused by the time it takes to do due diligence. That's clearly a factor, but actually we can normally plan for that. What happened last year, or actually more the end of the previous years, we just got a few unexpected loans repaying, and it took time to obviously put that money back to work. Right now, we don't have any cash drag. In fact, we have some very modest amount of leverage. So we have, less cash than we're using on our revolving credit facility right now. We don't employ structural leverage, but we do use revolving credit facility to manage the balance sheet. And that obviously eliminates cash drag. So as things stand, I don't expect this financial year to see any material effect from cash drag.
Thanks, Steve. There's a question on the US. What effect is Trump's apparent lack of interest in infrastructure and renewables having on the loan market in the US? I think the question may have just been posted before the US slide earlier, so I wouldn't go into all of the detail on that. But suffice it to say that the US is still incredibly busy market for us and for the broader market. I would say it continues to represent about 50% of broader deal flow in infrastructure credit. Now that's even after accounting for what is likely to be a continued slowdown in additional renewable deployment. The US never had a particularly big offshore wind industry. It was maybe nascent, is perhaps the word to describe it, compared to what we have in Europe, in the North Sea and Baltic and elsewhere. Partly that's because of the strength of the onshore energy industry in the US, and there's partly geography as well, with a relatively narrow continental shelf and therefore deep waters harder to install. So offshore wind kind of has been a bit of the high profile victim of the recent policy and change of government in the US. But clearly there's some sort of risk to a slowdown in onshore renewables as well, particularly wind and to a lesser extent solar, because it's more fragmented and can be localized even down to people's roofs. I'd also say that wind and solar generally around the world have become pretty much competitive on a standalone basis. It does depend on location, scale, jurisdiction, and other technical considerations, but we're not likely to see a total cessation of renewables deployment in the US. But some of those larger projects which require federal and state and other involvement, we may see less of that for the time being. However, other sectors, digitalization in particular, remains enormous. So the growth of digitalization through social media is well understood, but that's been augmented by blockchain and AI and others that are really continuing to push ahead in that respect. And the US is clearly the world leader in that space. Transportation, again, critical for the US. It's probably one of the areas that has caused it to get a very low score from the American Society of Civil Engineers, and some high profile accidents involving maritime navigation, bridges, air traffic control, and so on, is likely to maintain strong political support for improved transportation, which I think one might say is considerably behind other G7 markets in terms of quality and focus. But the bipartisan infrastructure bill in the last administration continues to be looked at as a strong piece of legislation, even if the other renewables focused bill is now taking a bit of a back seat. Other aspects that are interesting, grid reinforcement, partly due to the historic renewables deployment, but again, also down to climate change and resilience and deglobalization. The US does need to improve its network, moving energy from A to B and to C and so on. Flood defenses, emergency services, whether it be relating to fire or flood and other issues, whether related to climate change or otherwise. All of these are areas that are important for the US, and so we'll continue to see it being very important. Also adding to comments we've had from other investors over the last few days asking about the US. The US is also very positive for us in that it maintains normally a slightly higher yield for the equivalent level of risk. So that is important for us in terms of maintaining our attractive dividend going forward.
Thanks, Matt. Sorry, I was going to take the next question, which is relating to credit losses. So, as people will realise, in any lending business, there's always a risk of bad debts. The same is true for infrastructure debt. There are a couple of mitigants. So, infrastructure tends to perform relatively well compared to other types of lending over the economic cycle, tends to be more resilient in recessions. And if you think about it, that makes sense, right? People still have to use energy and transport, etc., even in a recession. So these are providing essential services. And secondly, because typically infrastructure is backed by real assets, the lender's recovery following a default tends to be relatively strong, right? You have an asset that's going to hopefully maintain its value over the economic cycle. But nonetheless, clearly in infrastructure, you still get bad debts. So we report on this. We report what's called our loss rate, which is simply bad debts expressed as an annual percentage of the loan book. And that's just over 0.5%, which we believe compares 0.5% per year, which we believe compares very well to our peer group.
Thank you, Steve. We've got another question on interest rates and how we expect to manage a lower interest rate environment going forward, and also asking about our fixed floating rate exposure and if we're going to lower our floating rate exposure. And the answer is that we have lowered our floating rate exposure. We tended to run the fund at about 50-50 fixed floating. The infrastructure market offers loans in both interest rate formats, but we did probably about a year or so ago, increase our fixed rate exposure and lowered our floating rate exposure in anticipation of lower interest rates. So there's no expectation on our part to further lower the floating rate exposure. And we do want to keep some floating rate exposure because it helps to mitigate the volatility in our NAV due to changes in interest rates. So it's really important that we that we have that mix. But yes, we did make that move a while ago. In terms of lower interest rates going forward, we've been in this environment before. If you look at where policy rates are right now in the three big markets where we land, the US, the UK, and Europe, and where they are expected to be over the next coming year or so after the further rate cuts are enacted, you're looking right now at an average policy rate of about 3.6%. And if you take the average sort of street economist in terms of where they expect what's called a terminal rate to be, that's going out into early 2027, terminal rate being where will policy rates end up. That number is about 2.8%. So you're looking at about 80 basis points of cuts on average. That's about 325 basis point cuts. So we end up at 2.8%. What's really important for folks to remember is that we issued shares originally in the IPO back in 2015. And quite literally, we operated in a very low interest rate environment between, just to put some numbers around that, between 2015 right up until COVID, short-term policy rates ranged from minus 50 bips in Euroland to plus 2.5 percentage points in the US. And that 2.5 percentage points, if you remember, was right before COVID, 2019 in the US. The employment picture got pretty tight, and the Fed raised rates in the US just before lockdown in anticipation of higher inflation due to a tight labor market. We actually spent most of that 5-year period, 2015 to 2020, operating in a slightly negative interest rate environment to about 1% in interest rates. So if economists are right and we see terminal rates go down to 2.8%, we don't see any significant impact on the fund due to that.
Got 3 questions here, which are all about the portfolio and typical loan terms. So I'll take them together. First one is, what are the typical lending spreads or credit spreads that we achieve over benchmark or risk-free rates? The answer to that is historically it's about 4 to 6%. So LIBOR or Euribor or SONIA, as the case may be, plus 400 to 600 basis points. On top of that, we typically get lending fees and upfront lending fees, and sometimes repayment fees as well. Second question is, why is our average life relatively short? And I think there's 2 answers for that. One is there are some very long dated infrastructure loans out there. So things like some of the old PFI deals, some toll roads, utility companies can do 20-year plus loans. That tends to be low yielding, investment grade, typically fixed rate, and it's aimed at insurance companies. And it's or the lending group of insurance companies who are looking for long dated assets to match their long dated liabilities. That's not really representative of the broader markets, where you typically aim for, I'd say, 4 to 7 year maturities with some amortization. It provides, I think, a good balance between the sort of credit risk. So as a lender, you want obviously to have visibility on repayment, but also the borrower wants to have flexibility to repay the loans and manage their own balance sheet. So it's a structure that works. I don't think we're particularly short dated compared to the broader market. And then the third question is, I think in essence, do we have the right level of diversification? Could we have more? Should we have more than 60 loans or so in the portfolio? I think we're huge believers in diversification. I think it's the closest you get to a free lunch, in a sense, that you can reduce risk without reducing return. So yes, we like diversification. The balancing act is in private debt. You're doing a lot of bilateral loans or sometimes club deals where there's 2 to 3 lenders, and so there tends to be minimum investment sizes to participate. It's not like a investment in listed equities or high yield bonds where you could quite easily do 100 or 200 small investments. Actually, to participate in this market, you need to be able to do a minimum size, which is probably $20-30 million quite often, sometimes more. So that puts a floor, obviously, on the number of transactions. So it puts a ceiling on the number of transactions that we can do, just given the sort of minimum ticket or minimum investment sizes in different transactions.
Thank you, Steve. That sums up our fiscal year 25 SEQI results call. We'd like to thank everybody for attending, and we'll now turn it back over to the moderator.
Perfect, guys. That's great. And thank you very much indeed for being so generous of your time then, addressing all of those questions that came in from investors this morning. But Randy, perhaps before really now just looking to redirect those on the call to provide you with their feedback, which I know is particularly important to yourself and the company, if I could please just ask you for a few closing comments just to wrap up with, that'd be great.
Yes, absolutely. Well, we think that infrastructure debt presents a huge opportunity, and it really boils down to the fact that there's a huge need, not only in the US, in the UK and Europe, but also really around the world. And that is best spelled out by looking at what folks call the infrastructure spending gap, which is simply the difference between what's needed in terms of capital and what's been identified in terms of capital. Really, the demand for capital versus the supply. And the demand for capital is much higher. And what that means in practice is that spreads need to widen, things need to cheapen in order to attract private capital in to meet those huge needs for infrastructure. So we think it's an exciting sector. There's a tremendous amount of growth, and we see really strong investment opportunities going forward.
Perfect, Randy. That's great. And thank you once again for updating investors this morning. Could I please ask investors not to close this session, as you'll now be automatically redirected for the opportunity to provide your feedback in order that the management team can really better understand your views and expectations. This will only take a few moments to complete, but I'm sure will be greatly valued by the company. On behalf of the management team of Sequoia Economic Infrastructure Income Fund, we would like to thank you for attending today's presentation. That now concludes today's session, so good morning to you all.